The real estate market goes through cycles. There are ups and there are downs and everything in between. It's always been that way and it probably always will be. What you need to know is over the last few years, we have been in a crazy seller's market. Now that things have shifted, we are in a more neutral market and potentially headed back to a buyer's market in some parts of the country. This is great news for people who want to buy a home, especially if you're a first-time home buyer, because 6 months ago, you were probably having a hard time to compete to even get under contract. Inventory was limited. People were paying way over asking price. They were waiving their finance contingencies, the appraisal contingencies. It was just difficult for a first-time home buyer to even compete in that kind of market. Even though interest rates were at an all-time low, buyers were not able to compete to buy. Now, in this new market, even though interest rates are higher, there is still good news, which is that there's much more opportunity for buyers now than there was the last year or two. What's important to understand is that when you buy a house, it's much like getting married. You fall in love with the house. Even with maybe some of the blemishes, you're in love with it. Now that's where you're going to live and raise your family. But the interest rate component of your home financing, think of that more like dating. So you're not committed to it. Interest rates go up and down as well. And there's a very good chance that interest rates will be lower in the coming years, and that's a great opportunity to refinance. So if you're looking to divorce the rent, which I highly recommend, I want you to know that there are some strategies to help affordability even in the current interest rate market. As the real estate market shifts from a very much of a seller's market to more of a neutral market and even a buyer's market, depending on where you are in the country. As that shift takes place, what you're going to find is that there are going to be more sellers open to contributing towards your closing cost. So this is a really important key when we think about affordability, when we think about assistance. Seller-paid closing costs can be used in so many different ways, and it truly can help you reduce your monthly house payment, or it can help you reduce your closing costs. So let's think about this way. Let's say that you have a $10,000 seller credit. Now, 100% of that money has to be used towards your closing costs. You cannot use that for your down payment. But if you've got $10,000, let's say your closing costs are maybe $6,000, and that would include the lender fee, the title company fees, the appraisal fee, the first year of your homeowner's insurance, your escrow account setup, all the things that go into closing costs when a lender says that. It could also be the cost for you to buy down your interest rate a little bit, which is going to help you with that monthly payment. So seller concessions, this is a really big win. And trust me, a year ago, no seller concessions, or very little. Today, the percentage of closings that are happening across the country are increasing that have seller concessions on them. So let's leverage that. If you're thinking about how to buy down that interest rate, like what does that mean? And you're gonna hear all these terms. I wanna really be crystal clear that there are various options to do this. One, you can do a 2-1 buy down, which means what's happened is if the current rate today is, let's say it's 6.5%, then you can use the seller closing cost contribution to buy that interest rate down for the first 2 years of the loan. So the first year would be at 4.5%. The second year, your payment would be based on a 5.5% interest rate. And the third and subsequent year, your payment will be based on the 6.5% interest rate. So that is an option if you need a little bit of runway or a couple of years of just a staggered type of payment. The other option is just to do that same scenario, but only do it for 1 year. The benefit with that is it's less expensive to do a 1-year seller buy down. And so in that case, you're going to have a little bit more money left over to apply towards closing costs depending on how much the seller is giving you. Another option is just to buy down the interest rate period and not worry about the adjustment that happens with a temporary buy down. Adjustable rates could also be a consideration. We're starting to see with interest rate market where it is that an adjustable rate might make sense. Now, as a first-time home buyer, I really want to caution you, you've got to make sure you understand what that means. And not all adjustable rates are created equal. So I would recommend if you are considering an adjustable rate, you do an adjustable rate that has a fixed rate for a long period of time. For example, if we're quoting adjustable rates today, we're generally quoting a 7-year fixed rate, meaning that the rate is fixed for the first 7 years of the loan. And then on the 8th year, it's adjusting based on the index of the margin. So what that's telling you is you have a set payment for 7 years based on that interest rate, but it will adjust in that 8th year. So we want to walk through what are you looking for to do in the 7 years? Well, we're going to be looking to refinance you out of that 7-year fixed rate when 30-year fixed rates come down, and it makes sense to do that. So those are just some of the strategies and the ways that we see buyers using that seller credit towards their closing costs today. Now, if your cash out of pocket is the most important thing in your situation, then you can use the seller credit to limit your cash out of pocket. Now remember, the seller credit can pay 100% of your closing costs, depending on how much the seller credit is. So let's say your closing costs are $6,000 and the seller's giving you $10,000. That extra $4,000, remember, you cannot use that towards your down payment, but it can be applied to help you buy down your interest rate, which is a great strategy because it's a little bit the best of both worlds, right? Using that money to buy down the rate a little bit to help you with your monthly payment affordability, and then they're using the rest of it to cover all of your closing costs. So you're only going into closing with your required down payment for the home loan you're obtaining. As you can see, there are a number of opportunities to help buyers with affordability in today's market. Don't let the media or people you know scare you into thinking that today is not a good time to buy. It could be a great time to buy, but it depends on your particular scenario. If you're a first-time home buyer and you were struggling to compete a year ago or 2 years ago because you couldn't compete in that kind of crazy market, it's a fantastic time to buy. If you know anybody that's thinking about buying a home, please share this video. Until next time.